Welcome to part 7 of our financial statements video training. In this video, we discuss the remaining classifications on a corporation's balance sheet, namely long-term liabilities and stockholders' equity. Please print the PDF handout shown below this video as it will be used throughout the training.
Okay, long-term liabilities then are shown next. Long-term liabilities we sometimes refer to as non-current liabilities. And these would be then liabilities not due within a year. So if we have a long-term note, like our mortgage loan, right? The mortgage loan belongs down here, except for the next 12 monthly principal payments, which we stick up in the current liabilities under notes payable. And actually, we would have a separate line right under that would say something like current portion of long-term liabilities. So current portion of long-term liabilities would appear under current liabilities right after notes payable. So we'd have short-term notes payable, and then we'd have the current portion of long-term liabilities. And there we would show any principal that must be paid within the 12 months, even on that 30-year mortgage, right? So we're going to have the mortgage loan in two places then, right? The 12 principal payments due within 1 year of this balance sheet are going to be shown as current portion of long-term debt, which is going to be a current liability. And then all the rest of the principal that we still owe is going to be down in the long-term section. Okay, bonds are a form of long-term debt as well. Bonds usually pay interest every 6 months, and then the principal has to be repaid at maturity. Yes?
Why isn't interest shown in the current and long-term liability section? Because the interest could be huge.
Correct. The question is, why isn't interest reported under current or long-term liabilities? Now, I might put the interest under accrued expenses. So in my notes there I perhaps have accrued expenses, interest, right, owed for interest. So it is possible that interest that we owe is shown under accrued expenses. Otherwise it would show as interest payable. Now, we only show the interest that's due as of this date. In other words, sometimes we think of a mortgage loan and we say, oh, the interest on a loan is going to be gigantic. Well, we never record future interest anywhere on the balance sheet because the interest in the future isn't due on March 31st. So if I have a 30-year mortgage loan and the future interest might be $60,000 or $100,000 of future interest, I don't show that because that interest is not payable as of March 31st. I only show my obligations after this date, and we say that's the amount that's payable as of this date. So we do not show future interest.
But the long-term liabilities aren't due as of this date either.
We owe it as of this date. So the next question is, well, why do we show the note here? It's not due. It's due in 30 years. So here's the answer. This amount for the notes is payable. We do owe the full amount of the principal. They gave us the money and we owe the full principal amount, but we don't owe the future interest yet. We're going to owe the future interest as time goes on. So we're not going to show future obligations. Right? Now we could disclose that in our notes that, hey, we got a big commitment to pay interest in the future. But as of this date, we don't owe the interest. We do owe the principal. And to go back to the accounting equation, if we get the $60,000 or $6 million from the bank for a mortgage loan or something, we got the cash initially, and we have a big liability.